Hello everyone and welcome to the take-up video of the final exam review. So before you watch this video, you first have to go into the final exam review exercises and do the exercises. Okay, so there's 5 different tabs, so 5 different questions that you need to go and do, and then you can come and watch this video and see how the take-up is, because this is a take-up video. Okay. All right, so let's start with chapter 18. So on January 1st, 2017, Chang Inc. commenced business operations. At December 31st, 2019, the following information released to Chang. So there's 3 years of information, earnings, tax rate, depreciation, CCA, dividends, golf club dues. So what we need to do is prepare the journal entries to record tax for 2017, 18, and 19. Assume that loss carry forward usage in 2018 is considered to be probable. So you'll see here that in 2018 they have a loss. So what we basically have to do is step number 1, 2, and 3 for chapter 18, all in this one question. What you've seen before is the questions have been split up. So step 1 and 2 we do together, step 3 we do separately, but these do the full thing all together. Okay, so let's do step number 1 first, which is figuring out taxable income. So you start with accounting income, and then you adjust for temporary and permanent differences. And then you get taxable income, multiply by the tax rate, you get your current tax for the year. Okay, so for all 3 years, we have our earnings, we brought that over. We have depreciation expense, which is a temporary difference. Depreciation expense is not allowed to be deducted for tax purposes, so we have to add that back, 50,000 a year. But CCA is allowed to be deducted, so you'll see the CCA amounts here. So 180 in 2017, 0 in 2018, and 78,000 in 2019. So the reason that they didn't take any tax in 2018 is because, any CCA in 2018 is because they already have a loss. So there's no point taking CCA and having an even bigger loss when you can just save that CCA for future years. Dividends received is a permanent difference. This is allowed to be included in revenue for accounting purposes, but for not tax. So we have to deduct these 3 amounts. So 38, 60, and 60. Golf club dues. These are a permanent difference. They are allowed to be deducted for accounting purposes, but never for tax purposes. So we have to add those back. So any expenses that are not allowed for tax but are allowed for accounting, we have to add back. Any revenues that are allowed for accounting but not for tax, we have to deduct. So those are all our permanent and temporary differences. So now we can add everything up to find out what our taxable income is. So this would be our taxable income line. Okay. The reason that we're still doing this taxable income calculation for 2018 is because right now our accounting income is negative for 53,600, but we don't know if our taxable income is going to be negative or not. So we still have to do that exercise, even though we don't have to pay tax on a negative amount or on a loss. This is an accounting loss, not a tax loss. So we have to find out if tax loss is also, or if the taxable income, if it's also a loss. And after adjusting for those permanent and temporary differences, it is still a loss, so we don't have to pay tax on a loss. So we don't have any tax payable in 2018. In 2017, we have 143,600 times by the tax rate, tells us here 30%. So our tax payable or our current tax expense for the year is 43,080. In 2018, like I said, it's a loss, so you don't pay tax on a loss. In 2019, we have 641,600. Our tax rate in 2019 is 40%. So we have to have a tax payable of 256,640. Okay, so that's step number 1. We can do our journal entries now for our current tax expense for 2017 and 2019. So I think I did all the journal entries all together, but I can just show you them separately. So here, current tax expense, income tax payable, 43,080. So that's from this 43,080 after doing step number 1. 2018, we don't have a tax payable journal entry, but 2019, this tax payable amount, so you can do it two ways. So we know that we're going to have a loss in this year. So we know that in 2018, we're going to have a loss. So step number 3, when we get to step number 3, we're going to carry back the loss and we're going to carry forward the loss. Okay, so this 256,640 that we have determined will change if there is a loss carry forward that we can apply to this. So either we just, let's see, what did I do? So I didn't do the journal entry for it until later. Okay, so oops. So there's 2 things that you can do. You can either record this 256,640 and then revise it after, or you can just record it afterwards when we get to step number 3. Okay, so we'll hold off on recording this tax payable until we get to step number 3 because we know that we're going to have a carry forward or might have a carry forward. So let's do step number 2. Step number 2, you take only your temporary differences and you figure out your deferred tax expense for the year or deferred tax benefit for the year. So we only have our property, plant, and equipment for our deferred tax. So we're going to put it in our deferred tax schedule. Your tax basis and accounting carrying amount is your UCC or undepreciable capital cost and your net book value. So it says the asset cost was 600. So in 2017, 2017 is when they commenced business operations. So this asset was bought, let's assume it was bought January 1st, 2017. And our net book value at the end of 2017 would be 550. So here our carrying amount for, let me just show you again the deferred tax schedule, right? Tax basis, carrying amount, you take your tax basis minus your carrying amount, that gets you your temporary difference, multiply it by the tax rate, that gets you your deferred tax asset or liability, and your liability is going to be a negative. So the only temporary difference we have is related to our property, plant, and equipment. So like I said, carrying amount is 550, that's your 600,000 asset amount, minus your depreciation expense for 2017. And then same thing for your tax basis. You're going to take your 600,000 minus your 180,000. That's going to give you the 420 that we have here. Okay, so your tax basis is your UCC or your undepreciated capital cost, and your carrying amount is your net book value at the end of the year. So tax basis minus carrying amount gives us a temporary difference of 130,000 negative, right? Make sure you follow the negatives. Multiply that by your tax rate, and negative 39,000 is what your deferred tax asset or liability. It's a negative, so it should be a liability. So that's what your liability should be at the end of the year. Compare it with your opening balance. In this case, 2017 was when we started operations. So we wouldn't have an opening balance here, it would be 0. So the adjustment we need to make is $39,000 of a deferred tax liability. So I'll show you that journal entry before moving forward. This should say 2019, sorry. So here, we're gonna debit deferred tax expense, credit deferred tax liability of 39,000 for our deferred tax that we got from this schedule. Next, 2018, so we're doing something similar. We're gonna calculate what our UCC is. So our UCC 2017 was 420 for our tax basis. We're gonna subtract any CCA on that to find out what our new carrying amount is for tax basis. There was no CCA taken in 2018, so our UCC stays at 420. Our net book value at the beginning of 2018 is 550. We're going to subtract any depreciation in the year. The depreciation in the year was 50,000. So that gives us 500,000. Tax basis minus carrying amount gives us negative 80,000. Multiplied by the tax rate. So the tax rate has changed and we get 28,000. So our deferred tax liability account needs to be 28,000 now. So remember, once you do the schedule and you add up all your deferred tax amounts, that's the amount that should be the ending balance of your deferred tax liability amount. So if we have a T account, we have our deferred tax liability. In 2017, at the end of 2017 or beginning of 2018, we had 39,000 as a liability. We want our liability now to be 28,000. So this 28,000, we want our liability to be. So what do we have to do to get there? So we have 39,000, we want 28,000, so we have to debit 11,000 to get there. So that's the adjustment that we're going to do. Okay, so I'll show you the journal entry. We have here a debit to deferred tax asset liability. So this could be just one account that they either set up as an asset or set up as a liability. We know it's a liability, so we're just going to reduce our liability. Okay, so we're going to reduce the liability there and credit deferred tax benefit. When we're crediting this deferred tax, it's a benefit. When we're debiting it, it's an expense. But again, you can have this as a deferred tax asset expense / benefit. It could be one account that just kind of goes back and forth. And then 2019, we're doing the same thing. So we start off with a tax basis of 420 at the beginning of 2019, subtract our CCA. So CCA of $78,000 in 2019. And that's going to give you a tax basis of 342,000. We do the same thing with our carrying amount. At the beginning of 2019, our carrying amount was 500,000. And we took $50,000 of depreciation. So our new carrying amount in 2019 is 450,000. So 342 minus 450 gives us a temporary difference of -108 multiplied by the tax rate. So we need a balance of 43,200 in our deferred tax liability account at the end of the year. If you compare that with our opening balance, remember last year we had 28,000 as our opening balance, so we have to credit an additional 15,200. So if we go over to 2019, we debit deferred tax expense and credit deferred tax liability, 15,200. So you really got to remember that there is this opening balance that you have to compare what your deferred tax asset at the end of the year should be, compare it with your opening balance, and you get your adjustment that's required. All right, so now let's do step number 3, which is dealing with our taxable loss. So we wouldn't deal with this earnings amount, we would deal with this taxable loss amount. Okay, so we have a taxable loss of -454,000. First thing we need to do is figure out, can we carry back the loss? Okay, so we have -454. In 2017, we had a taxable income of 143,600. So do we have enough of a loss to carry back? Yes, we do. We can cover that 143,600, which means we would have made this 143,600 at 0. I'll just show you that. Okay, so we're taking our 454 loss and we're using it to carry back. We only have the 1 year, so you'd generally carry back 3 years back, but we started operations in 2017, so we would only carry back the 1 year. Okay, so we would get rid of, so we can allocate this loss to cover this full amount of income, which means our taxable income is now 0. 0 times 30%, we don't have to pay any tax on it. But we have already paid tax on it. So because we've already paid tax on it, we have to set up a receivable for that amount. So we paid 43,080 of tax. So we're going to get a refund for that amount. Okay, so let me show you the refund journal entry first. So in 2018, we're going to set up an income tax receivable and current tax benefit for that 43,000 we had to pay in 2017. After you do that, the next step is to figure out, is there anything left to carry forward? So if you started off with 454 and you used up all of this 143,600, let's see how much of a loss we have left over. We have a loss of 310,400 left over. So can we, next thing you do is you carry it forward. So the question says, the question has told us that assume the loss carry forward usage is in 2018 is considered to be probable. So because it's considered to be probable, we can record the journal entry for the carry forward. If this was not probable, we wouldn't be able to do the entry for the carry forward. If it was only like 30% probable, we would only record 30% of that. So we have the 310,400 as what we can carry forward. So we're going to do a carry forward entry. So I'll show you that. So our carry forward entry here, we have to multiply it by our tax rate. So in 2018, our tax rate is 35%. So 35% multiplied by our loss that we have left over to carry forward of 310,400. That's going to give us 108,640. So we're going to debit our deferred tax asset, and we're going to credit our deferred tax benefit of 108,640. Okay, so this is just showing that we do have a carry forward available to use in future years. So now let's go down to 2019. So right now in 2019, we have a taxable income of 641,600, and we have to pay 256,640 of tax. We didn't do the current tax expense entry yet because we know that this number is going to change because we have a carry forward. So we have 310,400 of a loss left over that we can use in 2019. So if we use that to go against this 641,600, let's see how much of income we would have. So if we took this 641,600, used up all of our 310 loss, we're going to bring down our taxable income to 331,200. So if we multiply that by our 40%, we're going to have a revised tax payable number. So let's multiply this. And our revised tax payable is 132,480. So instead of paying 256,640, we're only paying 132,480. So we can do that journal entry there. So we're going to debit our current tax expense, credit our income tax payable, 132,480. And then the last thing we have to do, since we used up all of our loss, right? We used up all of this 310,400 and allocated it to the 641. That means we've gotten rid of our loss, so we no longer have a loss, which means we no longer have this asset. So we have to get rid of this asset off the books. So in 2019, we're going to debit deferred tax expense and credit deferred tax asset to get rid of this off our books. So though that is step number 1, 2, and 3 for 2017, 2018, 2019. I also included, didn't ask you in this question, but I also included the income statement presentation for 2018, the year of a loss, just so you can kind of see what's going on here. So we have net income before loss. So that was your 453,600. 453,600 there. And then we're going to adjust that for our current tax expense, deferred tax expense, deferred tax benefit. Okay, so 2018, we had 3 things going on here. We had a deferred tax benefit of 11,000. We had a current tax benefit of 43,000, and we had a deferred tax benefit of 108. Okay, so these deferred tax benefits you could put together. I just showed it separately here so you could kind of see what was going on. So these are all benefits. So if we add up all these together, it's going to bring down our loss because it's a benefit, so it's a credit to our expense account. So we had a loss of 453. We had benefits that add up to 162,720. So our net income after tax is a loss of 298.80. All right, so that's chapter 18 take up. So let's go to the chapter 20 question. Again, make sure you've done this question before you watch this take up. All right, so we've received the following information from the pension trustee. We have a discount rate, we have all information about the DBO, we have all information about our plan assets, and then we have our opening balance of our net defined benefit in the beginning of 2016. So our questions are, prepare the pension worksheet under IFRS, journal entry under IFRS, what would be the journal entry for pension expense if we followed ASPE, and ending balance in the DBO and plan assets if this company followed ASPE. All right, so let's start with our pension worksheet. When we're doing the pension worksheet under IFRS, we have to have this OCI column, right? This OCI column is an extra one, only in IFRS, not in ASPE. So just remember to put in an extra column for IFRS for OCI. All right, so let's just start inputting all the information. So we have an opening balance of our net defined benefit of 72,000. It's a negative, so it's a liability. So we have to make it a negative on our schedule. Our DBO, we have an opening balance of our DBO of 600. Our DBO is a liability account, so we have to make it a negative on our schedule. Any liabilities are negatives on our schedule. Any assets are positives on our schedule. Opening balance of our plan assets, 528. Because it's an asset, we make it a positive on our schedule. Okay, and then we just go down the list and input what is relevant. So current service cost, that you need to know what two things that's going to affect on our schedule. And we have to have an equal amount of debit and credit. Okay, so 130,000. It's going to affect our pension expense. It's going to increase our pension expense, so debit to pension expense. It's also going to increase our liability, DBO, so it's going to be credit to our liability to increase that. Interest cost, did they give it to us or do we have to calculate it? So they gave us our interest cost. If they didn't give us our interest cost, we could just easily calculate that. You take your opening balance of your DBO, and you multiply it by your discount rate of 4%. Another thing you have to watch out for is if this past service cost arose at the beginning of the year, if it arose January 1st, then you would have to add that 75,000 amount to the 600 when figuring out interest. Okay, but because this was at the end of the year, we don't have to consider this 75,000 in our calculation of interest expense. So it's just our opening balance of our DBO multiplied by our 4% discount rate. So 24,000. So it was already given to us, but if it's not, then we know how to calculate it. The 24,000 is going to increase our pension expense, so debit to pension expense, and also increase our DBO, so credit to our DBO. Next one here is our expected return. And I don't think that was given to us, so we have to calculate that. To get your expected return, and this is only in IFRS, we have to multiply our plan assets opening balance, multiply by the discount rate. So same discount rate we use for our interest, and we get 21,120. Okay, so our expected return, 21,120, is going to be deducted from pension expense because it's a return. It's going to bring down pension expense, and it's also going to increase our plan assets. So we're going to debit plan assets there. And then the next thing we have to do is do the remeasurement of our asset to show what our in your plan assets account what the actual return is. So our actual return is 60,000. Okay, so we expected a return of 21,120, but we actually got a return of 60,000. So that's a really good thing, because we only thought we'd get 21, but we actually got 60, so that's great. So that works out in our benefit. So we are going to do a remeasurement of the difference between our expected return and actual return. The difference is going to go into OCI. And since we got more than we expected, this is a good thing. It's going to increase OCI, and increase to OCI means a credit, so a negative amount, right? So when you're increasing OCI, you're crediting OCI, which means it's a negative on our spreadsheet. And the positive amount, or the debit amount, goes into plan assets. So when you add up your expected return and the remeasurement of the asset, these two amounts added together should equal your actual return of 60,000. So just do a double check and make sure these two add up to your 60,000 actual return. All right, next one, let's look at past service costs, 75,000. Past service costs is going to be dealt with the same way as current service costs and interest cost. It's going to bring down your, it's going to bring up your pension expense, and it's going to bring up your liability. So debit pension expense, or positive pension expense, credit or negative liability. Next one, we'll do our employee contributions, 41,000. And this 41,000 is the actual amount you pay to the pension fund. So this is the actual cash coming out of your account. So it's coming out of the account, cash account, so it's gonna be a credit. And contributions increase our plan assets, so it's a debit to plan assets. Last couple ones here left to do. Benefits paid, 71,000. Benefits paid don't hit OCI, pension expense, or cash. It basically just, we're just gonna do, it basically just reduces your liability and reduces your asset. So if it reduces our liability, that's a positive amount, and we're gonna reduce our asset, so that's a negative amount. So debit or liability, credit or asset account. And then last one is our actuarial loss, 37,000. A loss is not a good thing. So that's going to debit our OCI, bring down our OCI, so positive amount. And it's also going to, a loss is going to increase our liability. So we're going to credit our liability. All right, so after you're done all that, add everything up. Then we can do the journal entries at this point before we finish the schedule and update our net defined asset or liability. So you just do the journal entries in the first three columns. So our OCI is going to be negative 1,880. Negative means credit. So we're going to credit OCI 1,880. We're going to debit net defined benefit. Pension expense, we're going to debit that 207,880. Credit net defined benefit. And then our cash account, it's negative, so we're going to credit our cash and debit our net defined benefit. Now that we know what gets debited and credited to our net defined benefit, we can do we can just update our net defined benefit on our schedule. So we're going to debit net defined benefit of 1,880. The second journal entry, we credit net defined benefit, so it's going to be a negative here because we're crediting it. And our last journal entry, we debit net defined benefit, so we're going to have a positive amount here. So then add everything up. Your balance in your net defined benefit now is negative 237. A way to double check this number is take the difference between your liability and your asset. So if you take the difference between these two, it should equal your 237. Okay, so that's a double check you can do. All right, so that was part A and B, doing the pension worksheet and journal entries under IFRS. Part C says, what's the journal entry for pension expense if the company followed ASPE? So pension expense would look a little bit different here. We would include our actuarial loss in our pension expense, And instead of our expected return, we would include our actual return in our pension expense. Okay, so everything else would stay the same. Current service cost is the same, past service cost, interest cost is the same. Our actuarial loss is not in OCI, it's in pension expense. And our actual return of 60,000 would be subtracted from our pension expense. So our pension expense would be 206,000, debit pension expense, credit our net defined benefit. And then our last question is asking, what would be the ending balance of DBO and plan assets if this company followed ASPE? So this is an easy one because it would be the exact same as IFRS. So we don't have to do any additional work here. We found out the ending balances of our DBO and our plan assets for IFRS. So it would be the exact same balance. So 795 negative for DBO and 558 for plan assets. Okay, so you don't have to go through that exercise of calculating the ending balances for the DBO and plan assets because they're exactly the same as IFRS, and we've already done that. All right, so that's chapter 19. So let's go to chapter 20 now. Again, before you watch the take up of this chapter 20, make sure you do the exercise on your own first, attempt it, and then you can compare the answers to this take up. All right, so this vendor Inc. owns a building, and then they sell the building to Baylor, and then they immediately lease it back. Okay, so this is the sale and lease back. So the original cost of the building was 10 million. It's 60% depreciated. The selling price is 8.5 million, which is the same as the fair value. Baylor agrees to lease the building to vendor for 20 years. Annual lease payments are $850, payable at the end of each year, right? That's important because that's going to affect our present value calculation. There is no guaranteed residual value, and vendor will pay all the building operating costs. So we know that this $850 doesn't include any like maintenance or property tax or anything like that. Starts January 1st, 2016. Vendor's incremental borrowing rate is 9%. We don't know the interest rate of Baylor. If we did know, because this company follows ASPE, we're going to use a lower amount. Vendor uses straight line depreciation, 30 years is the economic life. Collectability of payments is not risky, and there's no uncertainties around unreimbursable costs. So first requirement, determine what type of lease this is for Vendor Inc. and prepare all the journal entries for the lease in the 2016 year. So this company follows ASPE, so we have to determine whether it's a capital lease or an operating lease. To do that, we have to go through the 3 tests. So first test, is there a transfer of ownership? So I didn't see anything here about whether the lease transfers to the leasee at the end of the lease term. So we're going to assume no. There is no transfer of ownership or bargain purchase option. Second one is the economic life. What we're going to do is we're going to economic life test. We're going to take the lease term, which is 20 years, and divide it by the economic life, 30 years. Lease term has to cover at least 75% of the economic life in order for this criteria to be met. 20 divided by 30 is 67%, so it's less than 75%, so this test is not met. Last test is the investment recovery test. Here we're going to take the present value of the minimum lease payments and divide it by the fair value amount. If that percentage is more than 90%, then we have a capital asset here. So we have to do the present value calculation. Our PMT is 850,000. This doesn't include any extraordinary costs, so we don't have to subtract those out. So that's 850. The only discount we got was 9%, or borrowing rate was 9%. So we're going to use that for N. 20 years is we're going to use 9% for I. 20 years is our lease term, so we're going to use that for N. We don't have a fair value, future value. Our future value is either going to be our guaranteed residual value, which we don't have in this case, or the bargain purchase amount, which we don't have in this case either. And then we're going to use the end mode. Okay, so the mode you're going to use is end. So if you do the present value calculation, you can put it in Excel, so equals PV, and you kind of just take the rate, the number of periods, 20, the PMT, which is 850, future value, which we said was 0, and then the type, you put 0 for end mode. So if we do that, we get some big number here, 7,7759. You would compare that to our PV, sorry, we compare that to our fair value. Our fair value is 8.5 million. Okay, so if we take our present value divided by our fair value, we can actually get 91%. 91% is more than the 90% requirement for this test. So therefore, yes, this test is met. And because at least one test is met, this is a capital lease. So then journal entries here. First journal entry, because this is a sale and lease back, we're going to record the entry for the sale. So we're going to debit cash 8.5 million. It said it was 60 the question said it was 60% depreciated. So our depreciation should be, and so the cost of the building was 10 million. If it's 60% depreciated, then it's the 600,000 is the depreciation amount so far. We're going to get rid of the building, and then we're not allowed to record a gain. We have to record a deferred gain. So this 4.5 million gain on selling this building has to be deferred. And then at the end of every year, we're going to recognize a little bit of it each year for the 20-year lease term. Next thing you do on January 1st is set up the asset and liability, and that's the present value amount. Okay, so set up the asset and liability at the present value amount. And then at the end of the year, there's a few things we have to do. We're going to have to do our interest expense calculation. I didn't do an amortization table here because we only have to do journal entries for 1 year. So I thought it was just easier to do the calculation for the 1 year without doing an amortization table, because it didn't ask us for one, so we didn't have to do it. So to get the interest expense amount, we're going to take what our balance of our lease liability is. And since lease payments are at the end of the year, that means our lease liability is the 7,759,263, which is our present value. Multiply that by the interest rate, and we get 698,333. Or you can do an amortization table if you're more comfortable with that. Another thing, December 31st is we're gonna have our first lease payment. So debit lease liability, credit cash for the payment of $850. We also have depreciation expense. We're going to take our asset amount, divide it by the, so we have to decide whether we're going to divide it by the 20 years or the 30 years. We would only divide it by the 30 years economic life if the leasee was taking ownership of the asset at the end of the lease term. So we know that that's not happening, so we're going to use the 20 years. Okay, so our asset amount divided by the 20 years, we're going to have depreciation of 387,963 every year. And the last thing we have to do is record a portion of this gain. So we have a gain of 4.5 million that we deferred. So every year for the next 20 years, which is the lease term, we're gonna be able to recognize a portion of that. So 4.5 million divided by 20 years gives us 225. So 225,000. We'll debit our deferred gain and we credit our depreciation expense, 225. So those are all your journal entries for the first year of this lease for the leasee. Our next question is determine what type of lease this is for Baylor Inc., so the lessor. To determine what the type of lease this is for the lessor, we first have to go through these 3 tests for the leasee. We've already done that. We know it's a capital lease for the leasee. Therefore, we know it's not an operating lease for the lessor. Sorry, we still have to go through 2 other criteria. Sorry. So yes, it is a capital lease for the leasee. That's the first requirement. Second criteria, you're asking, is the credit risk normal compared to other receivables? So if you go back over here, it says collectability of payments is not risky. So it looks like the credit risk is normal because they said it's not risky. So we'll say yes to that one. There's no risk in collecting payments. And then our unreimbursable costs reasonably estimated is our third criteria. So let's see. It says there are no uncertainties for any unreimbursable costs. So therefore, if there are no uncertainties, then yes, it's reasonably estimated. And therefore, this criteria has been met. So all 3 criteria need to be met for this to be either a sales type or a direct financing lease. So we know here that it's not an operating lease for the lessor, it's one of either sales type or direct financing lease. To figure out which one of these 2 it is, we have to compare our lessor cost to the fair value of our asset. So the lessor cost, if you go back up here, Baylor agreed to pay vendor 8.5 million. So that's the lessor cost. And it says which is the fair value at that time. So we compare the fair value and the lessor's cost. In this case, the fair value and lessor's cost equals each other. So when they equal each other, it means that it's a direct financing lease. If the lessor's cost is lower than the fair value, that means it's a sales type lease. So in this case, because the lessor's cost is equal to the fair value, this is a direct finance lease. And that's your requirement 2. Okay, so that's chapter 20. So let's move on now to chapter 21. All right, so for question 21, again, please go and attempt this question by yourself first, and then you can watch this take-up video of how it was done to see if you got your, whatever you did was correct. Okay, so Kitchener Corporation is following IFRS using the accrual basis of accounting. But when reviewing their records, some expenses and revenues have been handled using the cash basis because of errors made by an unexperienced bookkeeper. Income for 2013 was 29,000, 2014 37,000, and then there's some issues here. So rent of 1,100 was received from the tenant in December 2013, but the full amount was actually recorded at the time, even the rent related to 2014. So they got some rent in advance, but it was supposed to be for 2014's revenue, but they recorded it in 2013. Next issue, wages payable on December 31st have been omitted from the records and instead entered as an expense in the following year when paid. So all these amounts of the accruals ended up being expensed in the following year instead of being accrued. And then invoices for office supplies purchase have been charged to expense accounts when received. Inventory on hand at the end of the year had been ignored and no entry was made for them. Okay, so instead of recording these in a supplies inventory account, which would have been an asset, they charged it to expense right away. Okay, so you're not supposed to do that. You're supposed to charge, you're supposed to put it in supplies inventory, and then at the end of the year, count up your inventory, see how much you have left, and then expense the amount that you've used up. So what we have to do here is prepare a schedule that shows correct net income for 2013, 2014. We need to prepare the journal entries to correct 2014 net income. And then looking at an opening balance of retained earnings of 95,000 in 2013 and 124 in 2014, we have to prepare a schedule that shows the restated retained earnings. So let's start With A, we have to do a revised net income. So we'll first start with the net incomes we have here, 29,000 and 37,000. So we'll bring those ones over. So we'll start with this and then we'll do some adjustments. I'm going to put 2012 in here as well, even though we don't have to revise our net income from 2012 because we do have some issues in 2012 as well. Okay, so we'll put that there so we can see. And also when we do the restated retained earnings statement, the first rule is any errors prior to the comparative year need to be adjusted in the opening retained earnings of the comparative year. So this 95,000 is going to be wrong, opening retained earnings in 2013 because of the 2012 errors. So we need to do the 2012 amounts too. All right, so first one, rent was received in 2013 and they put it all in rent revenue when it was supposed to be revenue for 2014. So if you want to, what I like to do is look at the journal entry that was done. So the journal entry that was done, they debited cash, credited rent revenue for 1,100. Right? They did this in 2013 when they should have done it. They should have put this, it shouldn't have been rent revenue, it should have been unearned revenue. And then in 2014, it should have gone to revenue. So right now, since they've already put it in revenue in 2013, our 2013 net income is too high. So we have to take it out of 2013's net income. And because we never included this in revenue in 2014, we have to bring up our 2014 revenue amount. So income amount has to increase. Okay, so we take it out of 2013 and put it in 2014. The wages that were not accrued is the next one. So in 2012, 2013, 2014, there wasn't, wages were not accrued. They were just expensed in the following year when they were paid. Okay, so what they should have done, so for example, in 2012, they never did an accrual entry. What they should have done was they should have debited, wages expense, debit. They should have credited wages payable. And they should have done this for $900. Okay. They didn't do this entry. Instead, when it came to 2013, they did this entry in 2013 instead of 2012. So because they never did this entry in 2012, net income's too high in 2012. So we have to bring net income down here. So we have to subtract it from 2012. And because this was done in 2013, when it should have been done in 2012, our expense is too high in 2013. So our net income is too low. So we need to add the 900 to bring that up. Same thing for 2014, we were supposed to record 1,400. Sorry, 2013, we were supposed to record an expense of 1,400. We never did. So our net income's too high. So we need this 1,400 to bring down our net income. We did record this 1,400 in 2014 instead, but we shouldn't have. So we have to add that back. And then same thing for 2014, the $1,200 accrual is missing in 2014. So we have to add, subtract that from our net income. We need to include the expense there. All right, so that's for the wages. And then the last one is the supplies inventory. So we can look at what happened instead of what should have happened. So in 2012, what they did was they debited supplies expense and they credited cash. So $500. What they should have done is not debited the expense, but debited supplies inventory. Yeah, so this shouldn't have hit the income statement. So right now, income is too low by 500 in 2012, so now we need to bring it up. This instead should have been in supplies inventory, and then in 2013, it would have been used up. So it should have had the expense in 2013. So in 2013, we should be expensing the 500, not in 2012. Same thing in 2013, what we did was we debited $750 to supplies expense, which was not supposed to happen. So we need to add it back. what we were supposed to do was put it in inventory, and then in 2014, we should have expensed this. So we need to expense this in 2014. And then the last one, we put $1,200 in supplies expense in 2014, but it should have gone in supplies inventory and expensed in 2015. So we have to add back that $1,200 in our supplies inventory for 2014. Right, so if you're confused about how to do it, do the adjustment to your net income, do the journal entries, figure out what they did, what they should have done, and then you can see from there what gets affected by it. Right. So after all that, add up your adjustments for 2013. So we have a revised net income for 2013, and then a revised net income for 2014. So 2,700, 650 in 2013 should be net income, and 38,750 should be net income for 2014. Part B asks us to prepare the required journal entries to correct the 2014 net income. Okay, so we only are looking at the 2014 amounts to correct the 2014 net income amounts. All right, so the first one, rent revenue received in 2013 when it should have been in 2014. We know that net income in 2013 is too high, so we should take that out. But we're not going to take it out of income or revenue for 2013 because the books in 2013 have been closed. So we're going to take it out of retained earnings instead. So we know that we have to debit retained earnings because we have to subtract the 1,100. And then what we should have done is recorded the revenue in 2014. So we're going to add do a journal entry to record the revenue in 2014 instead of 2013. So take it out of 2013 and put it in 2014. Wages not accrued. So we have two issues here in 2014. The first one is that wages were not expensed in 2014. Sorry, in 2013, they were expensed in 2014 instead. So we know that net income is too high in 2013 because this 1,400 was never expensed when it should have been accrued. So we would have to debit retained earnings in order to fix that 2013 error. And we weren't supposed to debit this amount to salaries expense in 2014, but we did, so we just have to reverse out the salaries expense in 2014. Yes. So because this related to 2013, so it shouldn't have to be in 2014's net income. Okay, so we dealt with that one, we dealt with this one. Next one is our wages accrual. We didn't do a wages accrual for 2014 when we should have. So we'll just do the wages accrual entry, which is debit our salaries and wages expense, credit our wages payable, 1,200. Okay, so we know that this error we know that we've done this error now. So we know that we have this error now, so we can fix it and set up the payable. All right. Next issue is the $750 of supplies inventory that we did not expense in 2014. We instead expensed it in 2013. So we have to increase our net income or increase our retained earnings for 2013 and record the supplies expense in 2014 instead. Okay, so we're going to debit our supplies expense for 2014 because this should have been recorded as an expense in 2014. And we're going to bring up our retained earnings because we shouldn't have expensed this in 2013. We should have expensed it in 2014. And then now we can do the correct thing to our supplies inventory for 2014. So in 2014, we debited supplies expense, credited cash. What we should have debited was supplies inventory instead. So we're going to debit our supplies inventory and get rid of that supplies expense that we had, because this should be, supplies expense is going to be recorded in 2015. So those are all the journal entries to fix these mistakes. And then part C says that assume that Kitchener had an unadjusted retained earnings of 95,000 at January 1st, so opening retained earnings in 2013, and then opening retained earnings in 2014 of 124,000. So we need to prepare a restated retained earnings report. So we're going to start with our opening balances. We know these are wrong. We know they're wrong because of all these errors here and all these errors here. So our 2013 retained earnings is wrong because of our 2012 errors. So we'll start off with our opening retained earnings amounts. If you remember the three rules or the three steps in recording a restated retained earnings, the first step is any errors prior to the comparative year get adjusted in the opening retained earnings in the comparative year. So that means our two errors we had in 2012, which was the we have to bring down net income by 900, bring up net income by 500. That would have, these two errors would have affected opening retained earnings in 2013. So this 95,000 is wrong. We have to subtract the 900, add the 500 for supplies. So our opening retained earnings should actually be 94,600 instead of 95,000. Okay, so that's our restated net income. And then the second step is any errors in the comparative year get corrected in the net income of the comparative year. So we've already calculated what the correct net income should be. So it should be 27,650. So we're going to correct that here and just show the correct net income, 27,650. It doesn't talk about any dividends. We don't have any information of any dividends. We can assume that there are none. And we get our ending retained earnings of 122,250. And then rule number 3, the total of all your prior period errors get corrected in your opening retained earnings of your current year. So in 2014, we have opening retained earnings of 124. We know that that's wrong. So our 2013 errors and or all our errors from our prior periods need to be adjusted. But if you look at this, so we're concerned with our opening retained earnings for 2014 not being correct. So if we had our net income was too high in 2012, but too low in 2013, these two cancel each other out. So this is a counterbalancing error. And they basically fixed itself by the time we get to 2014. So we no longer have an error in our opening retained earnings of 2014 because our retained earnings was too high in 2012, then too low in 2013, and it balanced each other out. So by the time we get to 2014, we no longer have this error. Same thing here for the supplies inventory in 2012. In 2012, our net income was too low by 500, so we're adding 500. In 2013, it was too high by 500. So by the time you get to opening 2014 retained earnings, these two have canceled each other out and there's no longer an error. So we don't have to deal with these two errors, we'll just have to deal with our 2013 errors. What we're going to do is subtract the 1100, add the 900, subtract the 1400, add the 500, subtract the 500, add the 750. Okay, so all this is going to be adjusted in our opening retained earnings of 2014. Okay, oh sorry, I did too many of them. I said we don't need to do this. We don't need to do the 900. We don't need to do the 500. So it's just our 1100, 1400, and 750 we have to adjust for, because those still have an impact on opening retained earnings of 2014. So now our new balance in our opening retained earnings in 2014 is 122,250. And this should be the same number as your ending retained earnings December 31st of 2013's, right? So it should be the same now. Then we're going to add our net income for 2014, which we've recalculated here, 38,750. So we figured out what the correct amount was. We've already done that calculation. So we're going to put that there and then add these two up and we'll get our ending retained earnings for 2014. All right, so any errors before the comparative year get adjusted in the opening retained earnings of the comparative year. Any errors in the comparative year get adjusted in your net income of the comparative year, and all your prior period errors that would affect opening retained earnings of the current year get adjusted in your opening retained earnings section. We want to make sure your ending retained earnings in 2013 match your restated opening retained earnings in 2014. Okay, so let's move on to chapter 22. All right, last question here. I didn't have questions for chapter 23 because we just did that chapter, so it should be really fresh in your head, so you can have those exercises to study off of. Okay, chapter 22. Again, do this question first by yourself, and then you can watch the take up. All right, so we have financial statements of this company. We have some additional information, and we have to prepare a cash flow method using the indirect method. Right, so we start off with our operating activities. I already did the change from this current year to prior year. So the change in all of our statement of financial position accounts, right? So change from this year to prior year. So we can use these when we're doing our changes in working capital accounts. For the indirect method, we start off with our net income. So 91,480. Okay, so we'll start with our net income and our operating activity section, 91,480. Then we're going to get rid of any non-cash items. So we're going to adjust our net income for any non-cash items. So let's take a look at if there's any non-cash items here. We have sales, we have gain on sale of equipment. So that is a non-cash item because you didn't get cash of 8,750. So we have to, any gain or revenues, we have to subtract that from our net income. So we're going to subtract the 8,750. And then we'll keep going and see if there's any other non-cash items. There's depreciation expense right here of 58,700. That is a non-cash item, so we have to add that back. 57,700. Any other non-cash items? We have cost of goods sold, operating expenses, income tax, and interest. So those are all cash items, right? So first thing you do is take your net income and then adjust for any non-cash items. And then the second part of your operating activities is you have to account for any changes in our working capital accounts. So we have accounts receivable went up by 53,800. If accounts receivable went up, that means cash was not received. So we have to subtract that amount. So we're subtracting the 53,800 there. Go back up to, we have inventory. Inventory went up. If inventory went up, that means we didn't get the cash, right? Only when we sell inventory do we get cash. So inventory went up. So we have to subtract the 19,250. So subtract 19,250. Then we'll go over to our current liabilities. So those are our two only current assets. Everything else is capital assets. Our current liabilities here. We have these two. So our accounts payable went up by 4420. If our accounts payable went up, that means we didn't pay cash. So that would increase our cash amount, 4420. So we add that. So if there's any increases in accounts payable, we would add those. Our accrued liabilities went down by 6730. So if our accrued liabilities went down, that means we paid cash. So we have to subtract this 6730. So minus 6730. So those are we had two current assets to current liabilities. Add everything up, we get 66,070 for our operating activities. For our investing activities, let's look at our long-term assets. So we have investments in land and we have property, plant, and equipment. Investments in land went down by 22,000. So it looks like we probably got rid of some land. Property, plant, and equipment went up by 85,000. Before we make any assumptions about this information here, let's look at the notes. Okay. So our notes tell us investments in land were sold at cost during 2014. So if they were sold at cost and our investments in land went down by 22,500 and they were sold at cost, then they were sold at this amount. Okay, so 22,500 is how much we got. So we can show the sale of investments of 22,500. We're going to add that amount because we sold something, so we would get money. So that one's done. Let's look at the notes again. Equipment costing 56,000 was sold for 1,550, resulting in a gain. So we know our property, plant, and equipment went up by 85,000. So something was sold, but then something also had to have been bought. So let's take a look at what this journal entry would look like to determine how much did we sell this for. So again, think about the journal entries to see how much we sold this for. So we need to figure out what we debited cash. So we would have debited cash an amount. We would have debited our accumulated depreciation to get rid of this. We would have credited our equipment to get rid of our equipment, and it says it's resulting in a gain, so we would have credited a gain. Equipment costing 56,000, they already told us that. We have that amount. The gain, how do we figure out how we know if we have a gain? So remember we had a gain on sale of equipment, 8750, right? So we know that we have that of 8750. So we have a couple things to figure out, our cash amount and our depreciation, accumulated depreciation amount. Let's see if there's any other notes that will tell us. Common shares were issued in exchange for some equipment during the year. No other shares were issued. The remaining purchases of equipment were paid for in cash. Okay, so we know that there was remaining purchases paid for in cash. So this 9,500 of accumulated depreciation, that includes buying some stuff and includes selling some stuff. They're selling one equipment. So one way to figure this out is we can look at like the PP&E and how it changed. So our PP&E went, our opening balance was 205,000 and then it went to 290,000. So we need to figure out how that changed. So we started with 205, we ended with 290. We know we had sold equipment for 56,000, so we got that. We it says here that common shares were issued in exchange for some equipment. No other shares were issued. Okay, so let's see how the common shares amount changed. So common shares went from 250,000. Sorry, it went from 200,000 to 250,000. So it increased by 50,000. So it says common shares were issued in exchange for some equipment, but no other shares were issued. So we know that that 50,000 was for the exchange of equipment. So we would have debited equipment, credited common shares of 50,000. So that there was no cash involved with that. So if we started with 205,000, ended with 290, we subtract equipment sale of 56,000, add 50,000, we have 91,000 left for equipment purchases. Okay. So this $85,000 difference between this year and last year comprises of these three things. So equipment purchases of 9,100, 91,000, we would have bought equipment, so it's going to bring down our cash of 9,100. Okay, so we're still trying to figure out how to get to this. Oh, it told us, that's why. Okay, so sorry, I didn't realize that it already told us that equipment costing 56,000 was sold for 1,550. Okay, so there actually isn't more investigation we have to do about that. But sometimes it doesn't tell us. So we'd have to figure that out by going into our accumulated depreciation, figuring out what the changes in that. Okay, so here, 15,550 is what the cash amount was. Okay, so sorry, I didn't read that one properly. So it was sold for 15,550. So 15,550 we would add because we sold something. All right. Okay, next, so add all these up. Cash flow from investing activities, negative 52,950. Cash flows from financing activities. Financing activities are your long-term liabilities and shareholders' equity section. So let's go to our long-term liabilities. We just have a notes payable. Notes payable went up by 70,000. So if notes payable went up, that means we got some cash. So we got $70,000 of cash. So we're going to add the 70,000 here, issue of notes payable. And then we have to look at our shareholders' equity as well. Common shares went up by 50,000, but we know that that was exchanged for equipment. So we know that that's not, that did not affect cash. And then retained earnings went up by 53,110. We want to see if that went up just with our net income amount or if there's anything else included. So our net income is 91,000, but retained earnings only went up by 53,000. So we know there's something else going on here. Another thing that affects retained earnings is dividends. So it looks like there were some dividends paid, and that's why retained earnings didn't increase by the net income amount. So we can kind of do the same exercise here. We can look at what's the opening balance of retained earnings, what's the closing balance of retained earnings, and how did we get there? So we know net income is going to increase retained earnings. So if you add these two up, subtract your closing, we get our dividends paid. So dividends paid of 37,670. So 37,670 is going to decrease our cash. So then you can total that up. So we have our cash flow from all three activities. We're going to total all three of those up. So the change in cash should be 45,450. And we can actually see if that is correct by going to our change in cash. So 45,450 is our change of cash there. We're going to show our opening balance of 47,250. Okay, 47,250. Add change in cash plus our opening balance, and we get our closing balance of 92,700, which matches our closing balance here of 92,700. All right, so that is the take up of the final exam review. Hope that was very informative and useful for you, and take care.